The issue of collectability is something that is particularly problematic when it comes to revenue, and we're going to talk very quickly about how it's addressed in AASB 15. Probably the best way of thinking about what it practically means is to think about a simple example, and here we have a company which is entering into a contract to sell the Waratahs a scrum machine. The purchase price is $500,000. A non-refundable deposit or payment is required on delivery of $50,000 on the 15th of January, and the remainder is payable at the end of the playing season, the 31st of August. Now, the real question is, when do we recognise the revenue, and how do we treat the payment on the 15th of January? This is complicated by the fact that the Waratahs' performance hasn't been very good. They may not last the season, and hence there is the issue of collectability. And this is really going to determine when we should be able to recognise the revenue. When the sale is made, maybe on the 15th of January, or on the 31st of August, when we get paid. That's a bit too close to cash accounting. Because collectability is doubtful, you can't actually recognise the revenue on the 15th of January. You can't even recognise a portion of it, because what that would suggest is that you're recognising revenue which you might then have to unrecognise if it can't be collected. So the issue is that you can't recognise the revenue on the 15th of January because it's not sufficiently sure of collecting the full $500,000. And so instead what you'd have to do is you'd have to recognise the cash received as unearned revenue. This would have to be re-evaluated constantly over the period until the revenue was ultimately could be recognised. Now, fortunately, the Waratahs started winning games, and by the 31st of July, it was determined that they would be able to survive the season. Hence, you would get paid for the scrum machine. So, collectability was resolved on the 31st of July, and this suggests that on the 31st of July, we'd recognise the revenue, the full amount, $500,000. The amount that you'd previously recognised as unearned would now be recognised as earned, and you'd recognise an account receivable for the balance that's outstanding of $450,000. Of course, on the 31st of August, you'd then recognise the receipt of that payment. There would be no revenue because it's already been recognised. Now, that might seem a little bit of a problematic approach to recognising revenue, but it's a lot simpler than all of the other approaches which would be necessary if you tried to recognise revenue on the 15th of January. If you recognise revenue on the 15th of January, what would you recognise as the cost of goods sold? Would you start to